Guest had a buy rating on the stock, and even his expectations were beaten. Joining us now, John Lovallo, home builder analyst at UBS. What do you make of D.R. Horton, John, and its report?
Hey, Tyler, thanks for having me.
You bet.
Look, I think a lot of the things that Diana described are exactly what's helping the new home market. There's very little existing home supply. Underlying demand is still very good. All that demand is being channeled to the home builders, and the home builders on the public side are taking a lot of share from the privates. What D.R. Horton reported today was a very strong quarter across the board. They took their outlook up. I think that everything is kind of pointing in the right direction for these builders to continue to operate even at a higher interest rate environment. And let's not lose sight of the fact that in October and November of last year, rates were even 60 basis points higher than they were today. And the companies still continue to operate very effectively.
I'm interested in one of your surveys. You say 34% of respondents plan to buy a home in the next 12 months. Historical average is 29%. 24% say they plan to sell their home in the next 12 months. Those are high. Those are surprisingly high numbers to me, given prices, given the level of interest rates, which we keep hearing are keeping people staying put in their homes because they don't want to trade a 3% mortgage for an 8%.
Yeah, no, it's a great point. I think what's really important to keep in mind is that there is this tremendous wave of demographic strength coming through the U.S. In terms of millennials and Gen Z reaching prime home buying age, life events, marriage, children, things that necessitate more space. And don't lose sight of the fact that there is a massive wealth transfer of $68 trillion occurring, channeling from baby boomers to millennials and Gen Z again. And this shows up in financing for mortgages. In fact, 25% of respondents to a survey about a year ago said that they're receiving, these are first-time buyers, receiving down payment assistance. That, coupled with the fact that the home builders are offering financing, so you're not paying 7.5% when you go to a builder. Maybe you're paying 5.5%, maybe you're paying 6%. The affordability equation starts to make a lot more sense.
You've got buy ratings on almost all. I mean, there's some where you have neutrals in your coverage universe, but you are very strongly oriented to strongly in favor of these home builders. Give me the thesis, basically.
Yeah, I mean, the thesis is the demographics that we just talked about, also the shift from resilient demand not being able to be satisfied by the existing home market, so all coming over to the new construction market. But don't lose sight of the fact that balance sheets are vastly improved for this group, right? If you think back even to 2013 when the market started recovering, you're looking at companies that are 18% debt to cap relative to close to 50%. They're generating strong cash flow through the cycle. They're 2 times the size that they were in 2013 in terms of market cap, and they're buying back stock, paying dividends. These are real companies that are being valued at half of the value of the market, at 10 times earnings. That seems a little bit dislocated to us, and I believe that there is room for that to close.